We are pleased to welcome each one of you to the first session in the newly launched FinTax, our webinar series for financial services industry. The focus for our today's discussion is banking sector. My name is Samir Gandhi, and I have the pleasure of hosting today's webinar. I am joined by subject matter experts Meenakshi, Khurana, Sandeep Jaiswal, and Baroz Kamdin along with me. Before I introduce the agenda, I would like to take a moment to highlight that all participants are on mute mode. If you have any content-related questions during the session, do type the same in the Q&A chat box. We will do our best to respond to your questions during the presentation. We will activate the feedback survey towards the end of the session. Please ensure to spare a few minutes to help us understand better if today's webcast provided you with useful insights and some of the suggestions or topics for going forward. We have known banking for years and also conversant with the tax implications for banks. Today, Meenakshi from our consulting team will explain us the concept of neobank and how it is complementing banking services at India. We would then be discussing the direct tax, indirect tax, and transfer pricing implications and the nuances for neobank. Post the discussion on neobank, we will then share updates on various recent developments via circulars and judicial pronouncement relevant to the banking sector. Let me now request Meenakshi to explain us the concept of neobank.
Thank you, Samir. Good morning, everybody. I'll maybe spend 7 to 8 minutes on introducing the concept of neobanking and also trying to help the audience understand what is the difference between a traditional bank versus a neobank. So given the age of technology, right, where we are used to using digital means for everything, right, from ordering our food to applying for a job or even conducting financial transactions. And obviously the financial services space has also accelerated their journey on the digital curve. We have seen the fintech revolution in India over the last few years, and neobank is a significant component of this fintech journey, which is disrupting the traditional banking system. Now, how are they unique is that they simplify financial services to the point, where they meet the expectations of today's digital generation by offering tech-first solutions. So as you can see on the slide, we're trying to show how the neobank journey has evolved, right from traditional banks, then traditional banks offering their digital fronts, and then these new tech companies coming in to disrupt what the traditional banks were doing. Now, in terms of, if I have to quickly cover what are neobanks, and I'm hoping that, there are some names, as you can see in the, below section of the slide, and I'm hoping some of these are familiar for the audience, and, you would have used these in the past. So if I have to very quickly cover about, what are neobanks? These are financial institutions, fintechs, with only an online presence, right? And they provide digital and mobile first solutions like payment, debit card, money transfers, and lending. So pretty much they are covering the entire gamut of financial services. Now, how do they do this, right? Obviously, they are not manufacturers of the product. They rely on banking partners to offer these products, right? And where their expertise lies is to, tie the technology piece, tie the artificial intelligence piece to offer a personalized, product, customer experience to the customer. Now, you must be wondering, how are neobanks different from, say, some of the digital fronts of these traditional banks, right? So they're not just focusing on digital banking, right? The difference they're bringing is in terms of the customer experience and simple things like, what is my turnaround time to open an account? And what we've seen is that a lot of traditional banks are now trying to, match what neobanks are doing in terms of the customer experience. One, small it is a disadvantage which the neobanks have is that, given that they are completely digital, certain products, say, for example, mortgage loans, right? The entire journey cannot be on a digital platform. And so they are playing in niche pockets of products, right? And obviously doing a very good job at that. If we can move to the next slide, Kashyapi, please. Now, what are the advantages, which neobanks are offering? One clear advantage which we're seeing is the low-cost structure. Unlike a traditional, legacy setup where the cost of the infrastructure, the cost of technology is higher, given that they do have the advantage of saving on the operational and the overhead costs. Their cost of operations are lower, and they're able to pass the benefits to the customers either by way of lower low or no fees, and also they offer higher interest rate on deposits, which obviously helps them attract the customers. I spoke about customer experience. A lot of neobanks, what we are seeing is that there's focus on artificial intelligence, automation, blockchain, right? 24/7 access, which is what is elevating the customer experience. Obviously, the fact that their service efficiency is also better than what the traditional banks would offer, because they provide near real-time services for account opening, etc. And also, there's a lot of customization and flexibility given to the customer in the way he wants to do the services with the neobank. The other sort of value add which the neobanks are doing is they have this ability to cross-sell and upsell, right? By looking at you as a customer, looking at, what is your pattern to purchase financial services and products, and also offer non-financial services and products which kind of tie to your buying behavior and preferences. And goes without saying, security is obviously something which is a must-have, right? So they have made those investments on the security side of thing as well. Now, if I have to, quickly talk about what are the emerging trends in this space, we do know that, there were some circulars around digital-only banks, etc., right? Niti Aayog also came out with a report, but the regulatory uncertainty continues to exist, right? We do not have a clear sort of stand from the regulator on pure digital banking models being allowed. So they will continue to have to rely on partnerships, right? And do a limited set of products. The other sort of trend which we are observing is obviously neobanks moving to, offering the full stack of banking solutions, right? So they're making the investments in the technology, which also help elevate the customer experience. And what we are also seeing is, going forward, it would not be a surprise if we see banks sort of looking up to neobanks to replicate their tech strategy and solutions. Also, I spoke about embedded offerings, right? Looking at, not just focusing on my financial services journey, but being able to introduce financial services products in other journeys, which I do, right? So that's, suppose I'm buying a TV on Amazon. So how do you embed, the financial services journey on top of that? So that's another trend which we're seeing. And we're also hearing that some of them are considering moving to a regulated becoming a regulated entity. Now, this is something which will evolve, and we'll have to wait to see how the regulatory landscape shapes up for them. So that's what I had in terms of, what are neobanks, what are the advantages, how have they differentiated, and what are some of the challenges and the evolving trends which are there in the neobanking space. I'll now hand it over to Sandeep, to talk about the GST implications for neobank. Sandeep, over to you. Thanks.
Thank you, Meenakshi. That was very insightful and definitely helped understanding the key dynamics of the functioning of the neobanks. Neobanks has indeed embraced technology to the core, and we all know how Metaverse is going to bring a difference to the banking sector. We will now talk about the impact of tax laws on the neobanks. We'll start with GST first. Well, to speak about GST and the key differences between neobanks and the traditional banks, I feel that there are a few broad areas one need to look into here. Now, considering the voluminous transactions of the traditional banks under GST, I feel that the compliance provisions have always been a bit different for them under GST as compared to the most other companies, be it let's say the normal invoicing reporting requirements, or to the calculation of ITC reversals, or even the more recent one, the e-invoicing requirements. So to elaborate this further, one should know that the traditional banks are not required to raise detailed tax invoices. Rather, a mere statement with minimal invoicing requirement is enough to comply. Even ITC reversal requirement for the traditional banks is on ad hoc basis, wherein they can directly consider 50% of the ITC for reversal purposes. Also, there is no e-invoicing requirement for the traditional banks. Now, looking at the presentation, and also as explained by Meenakshi just now, we can quickly realize that while definitely neobanks are up and coming, they are not being currently fully regulated by RBI. So, therefore, now the question arises as to whether all the benefits which I just mentioned for the traditional banks would also be actually available to the neobanks. Well, the answer looks likely to be no. In fact, in the absence of clear recognition by RBI as a banking company or NBFC or FI, it cannot be said that without doubt that neobanks would be eligible for 50% reversal benefit. Now moving on to the next slide. And this is more from the advantage perspective for neobanks as compared to the traditional banks. So one major difference we note here is that between the traditional bank and the neobanks is the geographical presence of the two. Traditional banks have branches almost all over the country, while the neobanks are mostly virtual. And this is what was explained by Meenakshi as well. However, they do need to have a registered corporate office as per the Companies Act requirement. But that may be it. Therefore, it can be said that neobanks shall not have the impediment of doing compliances from various states. This actually saves them, from the hassles of dealing with the state-wise tax offices for audits and assessment purposes. Also, recently, 47th council meeting was held, and it was held on 28th and 29th June, which was on the eve of GST at 5. It was highlighted that banks, along with other FS companies, have not been capturing the place of supply properly in the return. The GST Council has therefore brought about a change in the way reporting needs to be done under GSTR 3B. I mean, obviously, state-wise compliances do play a major role in the origination of these lapses. However, neobanks are well placed in these aspects. So, one another aspect is worth noting is that due to lack of output services in few states, there is an accumulation of ITC for the traditional banks in those states. So either they are absorbing these ITC losses or they are trying to cross-charge. Now, cross-charge are sometimes getting litigated by the authorities due to the lack of presence of services while cross-charging. In fact, invoicing without services has come under the focal lens, which I just mentioned in the 47th council meeting, and it has been mentioned that no ITC shall be allowed to the recipient for these services. For neobanks, such problems may not exist because due to the presence only in few states and few GST registrations. Hence, they are free from the concerns of ITC loss or cross charges litigation to some extent. And they are able to utilize most of the ITC since they are present only in one or few states. Now, this might also bring business efficiencies and working capital advantages for the neobanks. Also, this leads to an easier explanation of correlation of ITC vis-a-vis the output services to the tax authorities during the GST assessments and audits. So these were the basic comparisons between the traditional banks and the neobanks, speaking from GST perspective. I now would hand over to Behrouz to let us know the key differences from the corporate tax perspective. Over to you, Behrouz.
Thank you, Sandeep. Thanks, Meenakshi, for setting the context and letting us know how the business model of neobanks have evolved. Coming to corporate tax, we've heard that neobanks are different from traditional banks, and therefore their main income source of neobanks is fees, which they receive for partner financial institutions or partner banks, and sometimes interchange fees which they receive from merchants on the credit cards which are there. So these are normally the revenue streams of neobanks. And what we also found that they cannot accept deposits. So their main investment or the money which comes in for funding is equity. So considering these two aspects, what are tax implications for them? Traditionally, banks get some specific deductions from income tax, like provision for doubtful debts, 36(1)(7)(a), or a special reserve for long-term finance at the 36(1)(8). Those will not be allowable to a neobank because it's not a bank as defined. It is not a regulated entity. It's basically a fintech. The other considerations which are very relevant from a neobank perspective is expenditure. So when a partner bank or a financial institution were to have a transaction with neobank, when they make the payment for that platform or the tool or the software, what is it going to be? Is it going to be revenue expenditure? Is it going to be capital expenditure? So we need to look at the agreements to see how that is going to be worded. And there's one decision that we are going to discuss later on, which also will be very relevant to determine whether the payment made should be revenue or capital. Then the question comes on withholding taxes. You'll need to withhold tax because whether it's royalty or it's fees for technical services has to be determined. There's a slight difference in the rates which are there. So we need to see as to how the withholding tax implications would come in. And of course, for the neobank, it is his income. It's fees which is getting. It's a business income for him, and that should be taxable. The second aspect that is very key for neobanks is Section 56, income from other sources. We've seen that unless a neobank is a startup, if they issue shares at a premium, that could be a questionable thing. It has to be at fair market value. And if it's not at fair market value, then there could be a question of having income being generated and taxed in the hands of neobank. Similarly, 56(2)(10) has to be looked into to say whether the shareholder is getting any shares at a price which is lower than the fair market value. So 56 becomes very relevant in case of neobanks. Equalization levy is actually applicable to non-residents. It's applicable to non-resident e-commerce operator. But however, if the neobank is an intermediary for the non-residents, and if it is treated as an agent of the non-residents, would equalization levy get attracted even to a neobank which is in India? Withholding tax, neobanks, we've seen that payment gateways, and sometimes they're the last mile when they're making payment to a non-resident. So if they are the last mile making payment to a non-residents, would they be required to withhold tax on a 195, though they are only an intermediary? Would they have to comply with 15 CSCB because maybe the Indian buyers have not complied with it? So these are some of the questions which need to be addressed, and a proper documentation has to be kept. The next is, of course, on e-commerce operators, where they need to withhold tax under Section 194(o), which has been introduced recently, on payments of sale considerations or fees paid to the e-commerce participants. If the e-commerce operators were not to do it, then would neobanks, which are basically the payment gateways or the payment intermediaries which are there, would they need to withhold tax under 194(o)? And CBDT has clarified, given their guidelines on this, has to be looked into, or they need to keep a documentation on their record to say that the e-commerce operators are fulfilling those compliances. So when we look at the neobanks, what we found out that their business model is generally that they're either 100% or a subsidiary of partner banks or financial institutions, or they could be independent but having exclusive arrangement with partner banks, which are there, or financial institutions, or they could be independent and serving several financial institutions, not just one particular thing. So whenever you are either a subsidiary or 100% subsidiary, or you have exclusive transactions, what comes to mind is related party transactions. Transfer pricing and related party transactions are very important from a neobank perspective to be evaluated and to be seen how it works. And here I bring in Sameer. Sameer will talk about the transfer pricing implications of transacting with a neobank. Over to you, Sameer.
Right, Burrows, and that's very much correct. I think related party transactions becomes very important today, and also it has an interplay with business tax and indirect tax as well, as we'll just discuss. I think as Burrows mentioned and explained to us, the two main points on neobanks from a transfer pricing perspective, how the neobanks are funded. And they don't, as we heard, I think they can't take deposits from public or otherwise. They are not banking company. So the funding of the neobank becomes very important, whether it's buy of equity or convertible cumulative preference shares, debentures, and so on and so forth on innovative financial instruments. And one of the points we have to be careful about is if the amount received which is over the fair market value of such instrument, then it can be considered as income under Section 56 of the Income Tax Act, as Burrows explained. Many times, this type of funding is from related party or a group company, which is normally situated outside India. And we have to be careful on ensuring that we apply arm's length principle on these transactions and payment of debt or coupon rate or a dividend rate, as the case may be. The other very interesting point is on the who owns the ownership of the IP or intellectual property, who owns the digital platform. As Meenakshi and Burrows explained, this is their main, I will say, revenue driver for the neobanks on the digital platform, and they keep investing and improving upon the digital platform. And who owns the digital platform, whether it is in India, outside India, who is developing the IP? As we know, if the IP is owned, say, in a Singapore company, as some of the structures we have seen in the industry, and the Indian company, the neobank, is acting as a developer for that digital platform, then obviously the consideration received by neobank will be required to comply with arm's length principle, our transfer pricing regulations in India for the development of IP, and subsequently if there is a payment of royalty or license fee to the IP owner. Some cases recently we also seen that the IP are subsequently purchased by the company situated in India, and then that requires to be obviously comply with the arm's length principle. And not to mention our normal transfer pricing transactions under related party as a related parties, whether it's intra-group services, management charges, some supervisory charges, and so on and so forth. So these are some of the considerations on a related party transactions we have to be careful about. I think one of the other point is on the neobank in India. I mean, they don't serve the banking partner just in Indian banks or banks situated in India. We have seen in the industry that many cases they are acting as a neobank to the foreign banks situated or headquartered outside India as well. And for those issues, the withholding tax and development of IP or revenue considerations, equalization levy becomes very, very important. So with that, let me hand over back to Meenakshi for a polling question. Meenakshi, over to you.
So very quickly, would like the audience to, answer the poll where we're asking, does your organization have arrangements with neobank? Sorry, my video was struggling to come on. Kashyapi, do you want to just quickly do a time check? Okay. Interesting to see that, most of us do not know whether our organizations have tie-up with neobanks, and this is kind of expected, right? Fairly recent phenomena, and obviously we tend to go with the traditional banking partners, right?
If I may just add here, I think mainly because there could be tax people involved, and maybe that's the reason they do not know. But I think they need to put in a process in place, because transactional neobanks, as we discussed, have implications both from direct, indirect, and transfer pricing. And therefore, the tax heads really need to know as to whether the bank or the financial institution has arrangements with neobanks or not. Thank you. Yes, Samir, over to you.
Right, Burrows. Thanks for those insights, Meenakshi and Burrows, on the polling questions. So let's move on our shift the gear to some extent and move to discuss the recent tax updates on indirect tax, business tax, and transfer pricing. So there are some interesting developments recently, Sandeep. So over to you to explain us and brief us on the recent developments on GST.
Thank you, Samir. So I would now take up the key recent GST updates relevant for the banking sector Well, it was a complete action-packed, 47 GST Council meeting this time, which was on the eve of GST at 5. Now, there were quite a few recommendations, which was made by the GST Council, which is relevant for FS sector and especially the banking sector. The recommendations were both from the rate perspective and also from the compliance perspective. Like I highlighted earlier, it has been noted specifically for the FS sector that the place of supply has not been getting captured properly in the GST returns. Now, obviously, with the federal nature of the GST, we all know how pertinent it is for the government to get the place of supply captured properly. And that is required for right payment of taxes to the right government. Well, now it has been mandated that place of supply needs to be captured as per the correct address of unregistered customers. And here it has been clearly highlighted that that some of the banks or the insurance companies there there are some lapses, and this is where it has been addressed. Another big change now is the reporting of negative ITC falling under section 17(5). Now it has been mandated that the negative list items for ITC shall be required to be reported separately. Now this requirement is even for banks, hence the 50% ITC is reversed after reducing 17(5) items. It would be relevant to note that while earlier, section 17(5) ITC were not traced properly and were being expensed out in the accounts, now a proper tracing and reporting is required. Hence, an added compliance requirement would be now to properly record these items in the books and the returns also. Surely, during the audit time, the officers would ask for the document trail on these items, and hence, proper substantiation would be the key over here. Another massive change is now for the banks, basically, is in terms of the invoicing requirement. Now, this is the requirement of the proper declaration in the invoices or statements issued by them. Earlier, what used to happen is that the recipient of the services from banks sometimes would not be aware that the invoice or statement is not required to e-invoice. Banks are now not required to raise. So now banks are required to give the declaration. In fact, it is also mentioned on this slide and it is visible on the screen. This would actually assist the recipient in ensuring that they are receiving a proper invoice. This would also help them in justifying the ITC and proper explanation to the authorities. So this is a mandatory requirement which is now required for all the invoices or the statements which needs to be raised by the banks. Next change is on the GST payment options. Now UPI and IMPS modes of payment has also been introduced for the purpose of depositing GST in electronic cash ledger. This in a way actually would serve the larger objective of the government in getting a proper GST payment trail, because they are also contemplating that one of the UPI entities can assist them in GST analytics on the payments. Moving to the next slide. Yes, now the first change here we see is on the interest liability. Well, interest liability shall arise now only on the net cash liability. Now that will be for the period starting from the date on which such tax was due to be paid till the date such tax is paid. So this is indeed a beneficial provision, as the interest shall be payable only on the net cash payment, and the privilege of credit balance lying in the return is given to the taxpayers. On the second point, perquisites provided to employees. Well, there was a press note earlier on this, which clarified that any perquisite which is paid to the employees, which is being reported under income tax, shall not fall within the ambit of GST. Now, this has been clarified, and there's a circular number 172, which has been recently issued, and this speaks about the same. The third point is on the relaxations provided in GSTR 9C. Relaxations provided last year basically has been continued this year as well. There are many relaxations actually provided last year, and some of them which I can recollect is, one is not reporting the HSN wise, input summary, or not reporting the details of the refunds in the way, it was prescribed earlier. Even the expense wise ITC components, breaking that into inputs and input services. Now, these were the relaxation which was provided last year. This has been continued in FY22 as well. Next, it has now been clarified that interest shall be applicable only if ITC is availed and utilized, rather than only on availment. So this is in line with the Supreme Court judgment, which was there earlier on in Swift Laboratories, which was a service tax decision. So this is in line with the same. So there was no provision under GST, and now this has been clarified under GSTS. Important to note here is that input tax credit wrongly availed shall be construed to have been utilized when the balance in the electronic credit ledger falls below the amount of ITC wrongly availed. So, and that is also to the extent of such utilization, I say ITC, which shall be the by which the balance in the electronic credit ledger is falling below the amount of ITC wrongly availed. So I would say this is actually a genius work, by the lawmakers, because the SSC now won't be able to inflate their availed balances in the return after the due date of filing the return. Until then, the tax officer that that there still lies a balance in the returns, and hence it should be considered as unutilized. Also, next point is, it has been clarified that the amount which is available in cash ledger under GST or IGST head, that can now be transferred to any other taxpayer registered under the same PAN. So basically, it should be the same company, but to separate GST, and that cash ledger balance can be transferred to the other GST and ID. Next is on the exemption of services, which is provided by RBI, IRD, and SEBI. So earlier there was an exemption which was provided, that has been withdrawn. So the discount income and the commission income, under the RBI, basically which is earned, now that would be falling under the ambit of GST. Moving on to the next slide. Now, this slide is actually focusing on the key concerning areas for the banks currently under GST. Now, this is on the deemed supply applicability for the cost usage brand, basically the brand usage, by the banks. So talking about deemed supply under GST, it says that the services provided between related entities without consideration, that needs to be taxed under GST. So there are various rules, in the GST laws, which outlines valuation methods for GST reporting purpose. I'm not getting into the details, but those rules are actually giving you how your valuation needs to be done. So while this is concerned, and this is a concern of brand usage, this is raised by the GST authorities a couple of years ago. This has again been, been picked up by the GST authorities. And recently there has been letter also from the authorities wherein they're challenging the Indian banks on free of cost brand usage while providing services, to the Indian customers. They say that, this is a deemed supply and attracts GST. Well, deemed supply provision is a reality under GST, and not all the banks are required to do so are complying with it. But the need of the hour would be to do the valuation of the IPR as per the GST laws and comply with the deemed supply GST provision at the earliest. Else, it would actually hit your working capital. Then the ITC provision also are, very strict, and availment would become difficult. So this is one area where, a focus is required. Also, one should not forget that, banks are eligible only for 50% ITC. So there's a hit of 50% ITC in that regard as well. So speaking about, the complexity in valuation, we have also noted that recently, or maybe, even the last couple of years, the tax department is actually coming up with notices, which is asking for ad hoc valuation of the brand usage. Sometimes, notices are in the range of 5% to 10% of your turnover. So because, there are no specific formula prescribed under the GST laws. Okay, so that will be it. Now I think there's a poll question we have. Then we'll pass it on to Barrows for corporate tax update. So let us take this poll question, and this is more from the GST assessment perspective. While we all know that this is the year where it has been picked up, but what we are asking is that how is the complexity level of the GST assessment which has been taken in the last 1 or 2 years. And there are 4 options provided. We're also comparing it with the service tax regime, whether you feel that in the assessment processes are almost similar and the complexity level is same while it was there in the service tax regime. Yeah, so we'll just see the results once it is out. Well, that is interesting. 41% are saying it's more difficult, and this is quite understandable as well because of the GST regime. Now we have state-wise compliances, especially for the banks. And because the centralized registration has moved away, obviously we are complying state-wise, and the authorities are reaching state-wise and both from the center and the state level. So 41% is the one. And the second option which we are seeing is people are neutral. They feel that it is more or less similar to the service tax regime. Okay, so thank you for this poll. Now I'll pass it on to Behrouz for the corporate tax updates on the banking sector. Over to you, Behrouz.
Thanks, Sandeep. So we will now be discussing income tax, certain decisions which have come recently. We are discussing that. And a circular which, of course, everyone would be aware of. We'll discuss that also on 194R. So start with the first decision that we've taken is in case of foreign banks. And we are aware of the special bench decision in case of Sumitomo, which dealt with interest paid by branch to HO, whether it's deductible or not. Sumitomo, the special bench was actually dealing with a case where it was India-Japan treaty, which had a certain particular wordings in the treaty. And therefore, the special bench took a view that based on the provisions of the India-Japan treaty, deduction should be allowed for interest paid by the Indian branch to its HO and overseas branches, because there's a special mention of that in the treaty. Now, this case which we are going to be discussing is actually of a Korean bank having a branch in India. India-Korea treaty is a little different. If you go to the next slide, we will see how the wordings are different in case of India-Korea as compared to India-Japan. And we don't have this sort of an exception which has been provided in the Korea treaty. And further, there's one more line which says that in Article 7.3, which clearly says that the expenditure wherever incurred should be in accordance with provisions and subject to the limitation of laws of that state. So this line is there in India-Korea, which is not there in India-Japan. Despite these differences, the tribunal, if you go back to the earlier slide, the tribunal has held that it is still allowable as a deduction even under India-Korea treaty, because what Japan has done is they have given certain restrictions first and then cowed out. Since there are no restrictions to expenses under India-Korea treaty, therefore there was no need of a cow-out. And since Article 7.2 says that it's an artificial hypothetical independence, which is there for Article 7, deduction should be allowed for interest paid. And this is very interesting because this is going to help a lot of other treaties also, like Singapore, etc., where it's very similar worded as Korea. So this decision is very relevant from a foreign bank perspective. The next one, what the question was, is that the interest received on the branch, whether that's going to be taxable. So they have said, yes, it's going to be taxable because under Article 7.2, it's supposed to be hypothetically an independent unit, and therefore whatever interest received by branch should be taxable. The third is the most important to say that the interest which the branch pays to the HO, is the HO going to be taxed on it? Now, in this very case, when they did the return of income, they offered this interest income under Article 11 at the rate of 10%. But in the appeals, they have claimed that it is not taxable for the head office because it's payment received from self. The artificial independence which is there under Article 7 cannot be extended to Article 11, and therefore it should not be taxed. This decision is actually for the assessment year 7-8. And as you would know, the Income Tax Act has been amended with effect from assessment year 16-17. There's a change in section 915, which now brings to tax the interest received by HO from branch in India. But there's no such change in the treaty. So can that argument still be continued even post-assessment year 16-17 is something which needs to be seen. Further, there is an article in India-US treaty which specifically mentions that such interest income is taxable for the head office in India. There's no such clause in any of the other treaties that we are aware of. Can that be imposed because of this artificial independence? Would that be taxable? So that's something which has to be seen and evolved. But presently, it is said that based on judicial proceedings, including this decision, it should not be taxable. There are two other things which are very important taken up in this decision. We have not listed over here, but I thought I'll just point that out. One was on section 44C. As you would be aware, 44C applies for deduction of head office expenses. And they say what are head office expenses? General administrative expenses, which are there, general administrative and executive expenses. And there's a cap on how much is to be allowed. It's basically 5% of your profits. They have raised a ground to say that 44C the limitation which has been prescribed in Section 44C should not apply to this Korean bank because of the non-discrimination clause in Article 25. The tribunal, and they raised this as an additional ground in appeal. Tribunal admitted the appeal, the additional ground, and the tribunal also allowed it for statistical purpose without any discussion at all on 44C. So that's very new. We'll have to see how judicial proceedings evolve on that. But that's something which people can look at. The next most important in this decision was basically the rate of tax. As we are aware, a foreign company is taxed at the rate of 40%. So this is a branch of a foreign company, and branch is a non-resident. Non-resident is taxed at 40% plus surcharge and cess. Indian banks are taxed at 30% in those years plus surcharge and cess. So there's a differential which is there. This bank took up this case to say that in view of the non-discrimination Article 25, there cannot be discrimination between the rate of tax, and therefore it should be taxed at a lower rate, which is applicable to domestic banks. The tribunal has given a very good discussion on what are the judicial precedents or the interpretations of how do you interpret a non-judicial high court decision. So there is a non-judicial, I mean the non-applicable high court decision. So this is a Mumbai Tribunal, and there's a Kolkata High Court in where they have allowed non-discrimination and said the lower rate will apply to a bank. That's a Kolkata High Court. This decision, this tribunal has distinguished that decision, said it's not applicable. One, because it's Kolkata and we are Mumbai, and they have really gone in depth to say why it is not applicable. I think it's a very detailed order. And of course, Kolkata Tribunal has not considered change in law. Having said that, they have not allowed in favor of the bank the lower rate of tax. If you go to the next slide, please. Next. This is a technical ground, but this is a Mumbai Tribunal again, where the bank actually had got a notice from it's an Indian bank. They had got a notice from the National Faceless Appeal Center, and they made the submission, they uploaded the submissions, but they also asked for a virtual hearing, a video call. They actually mentioned that, saying that they would like to have a video call. The CIT appeals and the National Faceless Appeal Center disposed of the appeal without giving a video call or personal hearing, and on material no record passed the order. So they went up to the tribunal, and the first round that they took up was on technical to say that this order should be set aside because it does not follow justice. Natural justice has not been done. And tribunal actually says that it is not following the procedures which have been laid down in the NFSC scheme of 2021, and it applies retrospectively. The provisions of that scheme apply retrospectively for the earlier years also, and therefore it should be allowed, and they remit back the matter to the CIT appeals. So this is very important because we've seen in some cases where they pass the order, though it's been specifically asked that a personal hearing through video should be granted. We've seen orders being received without granting of that. So that orders can be remitted back and set aside. The next slide, please. This is something which we were discussing earlier, expenditure on purchase of core banking solution, whether it's capital or revenue expenditure. Now, this case is of an Indian bank. What's happened is that this is a second round of appeal. So the first appeal, when it came up to the tribunal, so the AO said it's capital expenditure and allowed depreciation. CIT appeals confirmed the AO. Tribunal said that no, it is revenue expenditure, relying on IBM India decision, and allowed it as a revenue expenditure. The matter went up to High Court. The High Court said that no, the tribunal has not passed a very speaking order. It's a cryptic order. It is not properly discussed as to why it is to be allowed as a deduction. Decisions taken up by the department have not been discussed, and therefore they set aside the tribunal order. And they quashed it, and it's gone back to the tribunal. And this is a second round of appeal. Here the tribunal goes into the merits of the case, and there they say that this is an application software. It's not a system software. So they distinguish between application and system software. They say this is an application software. Secondly, what they say is that this is only to run the business more efficiently, more productively. It doesn't touch the income generating apparatus of the bank. So it's not for loans or investments or interest income. It is only benefiting or facilitating efficient running of a business. And therefore it's revenue in nature. And the third thing, they're saying that even though it's perpetual, there are fees that you have to pay, maintenance has to be paid. There is a person who's been allocated. So there's a project management team which is there. And therefore it is all revenue expenditure. So this is very important to be seen, whether you should take a view that whatever application software you're purchasing, can you claim it as revenue expenditure? Of course, depreciation is otherwise allowable, but then there is a timing difference. We go to next slide, please. This is the right over mortgage property. A bank actually has taken a property on mortgage. It's between the tax authorities and the bank. And that's why it's so very important to understand, to say that who has a right of priority over that mortgage property if there's a default which has been done by the person who's mortgaged it. So here in this case, the bank said that they are under the SURFACE Act, they are under the DR Act, and therefore they have a right over the mortgage property. The tax department is saying that no, they have a right because there was a pending proceedings which were going on. There was a demand which was raised prior to the mortgage of the property. Having raised a demand prior to the mortgage of the property, though the attachment notice was sent after the mortgage, the demand was raised prior to it, and therefore the tax authorities have a priority. The Madras High Court has referred to another decision in Janata Sahkari Bank and have detailed saying that in view of section 281, which is very clear, 281 very unambiguously says that who has the right of priority. The mortgage is void if there's any proceedings which are pending. And therefore, there are exceptions to 281. There are two exceptions. One is where it's for normal sale consideration and you're not aware of it. And second is you've taken a permission. So if you've not taken a permission, whether you can take a claim that I was not aware of it, though section provides for it, but now the case law says no. If the department has raised a demand or if the proceedings are pending, then they have a first right over the mortgage property. So this is very relevant from a business perspective of the bank. Next slide, please. This is a recent circular which has come, and I think most of the financial institutions are aware of it. This is Circular 12 of 2022. Section 194R was recently introduced into the Act by the Finance Act of 2022, which says that the payer has to withhold tax when they're providing any benefit or perquisite to the recipient in the normal course of business of the recipient. So it has to be in the business of the recipient. If you're providing any benefit or perquisite, you need to withhold tax. There's a clause or the subsection in 194R which says CBDT can issue guidelines. And such guidelines will be tabled in Parliament and they will also be binding on the taxpayer. We are all aware that circulars are not binding on taxpayers. However, this year they have clearly mentioned in the section itself, and the section has been passed by Parliament, also received the assent of the President. Now, the section contains certain clause where they have actually subcontracted that work to the CBDT. Will that hold true? And in the guidelines which they have given, they have clearly said that if it's a principal loan waived by the bank, it's taken as a perquisite or a benefit given. Now, loan waiver, whether it's interest or principal, would it become a perquisite or a benefit is something that needs to be considered. And especially you need to consider because of the Supreme Court decision which is there. Now, can a circular giving guidelines override a Supreme Court decision, which clearly says that 28(4) should be something which is not cash, and loan settlement is cash, or loan waivers are cash, and therefore it cannot be a benefit or perquisite. There's also something which comes in to say this, whether cash or otherwise, is a proviso to 194R. Can a proviso extend the main 194R provisions itself? And there are Supreme Court decisions for that also, which say the proviso cannot extend the meaning of the section. So you have all of this to be considered, and then a view has to be taken, because if there are any waivers post 1st July, you need to evaluate whether you need to make a withhold tax or not. What we understand is IBA and FIDC, Indian Bankers Association and FIDC, which is an association for NBFCs, have met up with CBDT and they've discussed this. We'll need to wait and see how CBDT responds to it. The next is on BEPS, OECD. We've heard that recently they said that it could be delayed to 2024. Pillar 1 could be delayed further. Pillar 2 also, which is the minimum tax presently, is at from 23 onwards. Many countries have adopted that. We need to see whether that also gets postponed to 24 or not. But likely it looks like these two, Pillar 1 and Pillar 2, may get postponed. If you look at domestic tax law from our perspective, Section 10 for notified funds, they've already said that you need to commence business before 31st March 24. So maybe likely dates could be 24. So this is all from a direct tax perspective. We will look at the polling question now. And I request the participants to please take part in the poll. Kashyapi, the next slide, please. Yeah, so here is basically a question that whether you should claim expenditure on softwares and like CBS, which are application software, should you take it as revenue expenditure or should you take it as capital expenditure? The responses are basically say that since it's a timing difference, we do not want to litigate. One is to say that, yes, we would like to litigate because the amount is significant. And the third is we are still not decided on. So if you can have the participants, please take the poll. Can we have the results for it, Kashyapi? Timing difference will be significant. So there's 53% who said that they would evaluate taking a revenue expenditure. And 24% said it's not worth the litigation cost. And maybe. So it's very good. I mean, if we have decisions like this, why not take the benefit of the decisions? So, okay, thank you so much. And over to you, Sameer.
Thank you, Burrows. That was very insightful. Many topics you covered on business tax. So quickly going to recent developments and judicial pronouncement on transfer pricing, both at India and outside India. So one of the interesting judicial decision is on characterization of a transaction, whether it's a guarantee or a support service. And as we know, characterization of a transaction is a most is a must or necessary before we go to benchmarking of that transaction. So in this case, quickly, the Indian branch was giving a counter guarantee to the beneficiary in India for ensuring proceeds from the customer in foreign country or borrowing it has made to the foreign party, which is obtaining a guarantee from its foreign bank outside India. And based on that, the Indian branch of that foreign bank is giving a guarantee to the beneficiary in India. I think some cases recently in India, the revenue authorities did take a position that that's a guarantee by Indian branch to the customer and it needs to be benchmarked, casing that Indian branch has given guarantee to the foreign bank. But the tribunal did not uphold that position of the revenue authorities and says that no, in this case, Indian branch was giving is more of a support service or a administrative service of giving a counter guarantee to the beneficiary in India, and what is receiving as compensation for services to foreign bank, foreign branch, its parent or associate branch is fine, and there is no need to benchmark as a guarantee. If we can go to the next slide, continuing on our discussion on a foreign branch and an Indian branch, as the case may be. And attribution of income to a P is important. I think Burrows also referred to it in an interest deduction earlier in one of the Korean case and Japanese case, bank case. And while we know Article 7 is very clear that the P has to be treated as a distinct and separate enterprise. And in this case, it was practically applied by the Italy Supreme Court, where the foreign branch of the at Milan in Italy transferred the loan portfolio to a third party, but the Italian tax authorities and the lower court both upheld that no, this loss arising from this transfer of loan receivable to third parties is not allowable as a deduction while computing income of the branch in Italy, because the endowment fund, or I will say for our easy reference, it exceeds the capital of the branch significantly. But the Supreme Court Italy said that no, applying the authorized OECD approach on attribution income to PE, what the Milan branch has done is correct. I think the revenue authorities did not find any fault with attribution of capital or a free capital to the branch in Milan, and hence the transaction of transferring the loan portfolio to to third party is not to be attributed to the parent, and the the deduction is allowable on the account of loss suffered by the Milan branch. If we quickly go to the next slide, Kashyapi, where continuing on the same trend or trail of attribution of income to PE, and especially this is for the foreign branch of whether Indian headquarter bank or foreign headquarter bank. We know the authorized OECD approach, which lays down 3 approaches to benchmark the free capital and the debt: capital allocation approach, thin capital approach, and regulatory minimum approach, which is like a safe harbor for what is the regulatory banks in India's case, RBI mentions or lays down the capital required by, say, the foreign branch operating in India. Recently, this has been authorized OECD approach has been, I will say, practically applied by many countries: UK, Germany, Japan. Hong Kong recently applied this via guidance on more detail by the Indian Revenue Department at Hong Kong, prescribing some detailed rules on how free capital has to be computed under authorized OECD approach. They did lay down very clearly that while regulatory minimum approach can be considered as a safe harbor, and it's maybe meeting arm's length criteria, but not in all cases, and not necessarily in all cases. And this, as I mentioned, is applicable to Indian headquarter banks operating in Hong Kong or other countries like Japan, UK, Germany, and other countries. And similarly, foreign branch, foreign headquarter banks operating in India. As I said, we have not heard finally on this. And some of the instruments, as we are aware in India, what is called innovative perpetual debt instrument. I think we have to still test it, whether it's a debt for arm's length principle as a deduction for tax computation, while it meets with the regulatory requirements of RBI norms following Basel norms. That it's a capital for central bank or Reserve Bank of India in our case, but it's a debt for the tax computation. If we go to next slide, and again, as I said, continuing the trend, what I and we decided today is on branch and HO. As we are aware, a special bench has been constituted in India by the President of the Tribunal in the case of Tebia Srinaik Transformable Group Company Limited. The case has been heard in Ahmedabad Tribunal, the special bench, somewhere in April 2022, 2 months back. We are awaiting the final decision from there, and we will see how the decision goes. But this has been very interesting decision we are awaiting from the special bench, whether the transaction between a branch and in India and its head office required to be benchmarked and comply with arm's length principle under transfer pricing regulations. The other quick update is on LIBOR transactions. As we are aware, LIBOR, which is always a norm of applying LIBOR rates for loan and financing transactions, which has been accepted as a norm worldwide in the financial services industry. This has been discontinued from December 21 for a tenure of which are of 1 week and 2 months, and soon it will be exited from 30th June 23 in next 1 year or so. And in place of that, we now have alternate reference rates which we need to apply. Industry is applying some of the alternate reference rates which we can see on the screen. I won't go into detail on that. Obviously, it is based on the respective currencies which is being quoted here in the financial world. On the other point earlier, I not to go back on branch and head office point, but yeah, there is a CBT schedule of November 19 of how to attribute income to permanent establishment, which is still a public consultation document, but that was more to attribute income to a agency P. But there was not much discussion except reference to Article 7 on how to attribute income or a free capital to a branch of a foreign bank. Let's take a quick polling question, Kashyapi. I think we may extend it by a minute or so. And while we take these polling questions, Sandeep, you are referring brand valuation of the brand for GST, and as you know, TP interplay is also very much there. So is there any guidance, Sandeep, you can give it to us on how you value the brand for GST and how we leverage TP principles for the same?
Yeah, sure, Samir. I think, see, Rule 28 of CGST rules, basically, it, speaks about the valuation of supply of services, when the transaction is between related entities. So ideally, one should try to kind of look into this rule first, and there are various, guidelines prescribed. For example, you need to first look at the open market value, and if let's say the open market value is not available, then what is the like quality of service, which is being provided by the banks. Even let's say you're not able to value based on that, you can go to Rule 30 or 31. So Rule 30 basically says that the cost of the service. So let's say when there's a cost of providing a brand, let's say the marketing cost, etc., then it needs to be 110% of that cost. Or if you're not able to do that also, then use the reasonable means. So there are various valuation methods prescribed, and one needs to follow to the same. But sometimes it is felt that it's a niche area, it's a niche item, and how do we go ahead and value that? So there is a concern in relation to that. Obviously, the TP valuation mechanism also needs to be seen, and one needs to see if there are cross-border transaction and there's a brand share over the same. So Samir, maybe can add to that, and maybe then we can have a firm answer on it.
No, I will just add for the constraint of time, Sandeep, that any issue today in tax issue, I think we have to see interplay with indirect tax, business tax, and transfer pricing to give a holistic solution to that problem. I think it's time has gone by. We used to take issue as standalone for the tax, say indirect tax. I think there is a interplay with other taxes as well. And in meantime, we have results. Kashyapi, thanks for showing us for us. So 63%, I will say majority, almost 65, saying that transfer pricing should be applicable on transaction between branch with head office and overseas branches. So, but yeah, I think this is in line with what Article 7 and authorized OECD approach on attribution of income to P. And it's interesting, the interplay, as I was saying, within taxes, and in fact, interplay of permanent establishment and transfer pricing is very, very interesting. Quickly, one question, Boros, for you. There is we are hearing many waiver of loans today, whether NCLT and restructuring of loans. The question is that whether it will be how we should take it, considering the circular you referred 12 by 2022 for waiver of loan. A quick update, Boros.
Yeah, so there is a Supreme Court decision, but like I said, the circular is coming under the section itself. It's not a circular under 119 section. It's under 194R, and the way it's worded, the guidance could be binding on taxpayers. So it's a risk that you have to take. So we need to take up and we need to analyze it correctly and properly. One, principal and interest components have different connotations. So you need to look at it differently. And then for principal component, whether you should take it as this, you can rely on Supreme Court, maybe take a council opinion on record to say why you're not withholding tax, and not withhold tax till such time that CBDT clarifies on it, because representations have already been made on that. So I think you can rely on Supreme Court decision, take a council opinion, and then not withhold tax. But otherwise, if you don't wish to take a risk, then it's best to withhold tax, because withholding tax, why should you involve litigation on yourself? It's for the payee to take it.
Right, Boros. Thanks. And this is all we have for today. We thank all of you for being with us today's session and taking active participation in the discussion. The feedback survey is live with questions flashing on your screen. Kindly spare a minute to share your responses. Will enable us to learn from that and keep improving. As I mentioned, your feedback is very helpful to us. We are also continuation of, as I mentioned, webinar on FSI. So our next session is on insurance on 10th of August at the same time, 11:30 a.m. So do join in for discussion on insurance implications on the industry, and then 3 taxes, indirect tax, business tax, and transfer pricing. Thank you, Baros, Sandeep, Meenakshi, for sharing the insights on banking sector, including neobanks. Special thanks to all the participants who joined us webinar today and stayed back 5 minutes beyond time. The webinar archive link and presentation link will be shared with you shortly for reference and forwarding to others who are interested in the same. Thank you once again, and have a great day.
Have a great day.
Thank you.
Bye-bye.